Hello, everyone. As you're coming into the webinar room, we want to welcome you. My name is Marche. I'm the webinar director here at Advice Chaser. And before we introduce our guest and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you today's educational presentation. A couple of housekeeping notes. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries before or after the webinar, during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your phone number as well. And if we can't get to your question during the event, we'll make sure someone reaches out to you after today's webinar. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to our presenter today, Alec, and I'm going to mess this up, Alec. Alec Bethurum, there we go, I got it.
That's perfect.
Is the Senior Portfolio Manager and Senior Financial Advisor at Sternet Capital. Alec is a graduate of Colgate University and has spent almost 25 years working on Wall Street. He has previously been employed by Bear Stearns, Prudential Securities, and Roth Capital, working in equity research, sales, and trading. Alec also worked as a proprietary trader for a West Coast-based hedge fund. Over the years, Alec's contribution to client success has evolved from focusing purely on securities research and to asset allocation to a more holistic advisory role, including involvement in behavioral finance, tax, and financial planning. Sternet Capital has been offering clients investment management and financial planning insights for more than a quarter century. Founded in 1989 as a New York City-based hedge fund, the practice moved to Kansas City in 1999 and transitioned to offering individuals and families access to institutional level financial planning and asset management. Today, Sternet Capital is proud to be a fee-only firm with a fiduciary responsibilities to put its clients and their needs first. And Alec, we're really excited to be here, and I'm going to go ahead and turn over the time to you.
Thank you, Marche, for that introduction. I really appreciate it. Thank you, everyone, for being on the call today. Title of our webinar today is Turning a Lifetime of Savings into a Lifetime of Income. And, we really kind of like that title because if you think about it, you've spent kind of your entire career with your labor as your source of income. And then, people get to retirement and they start to get pretty nervous about the idea that, they're no longer kind of masters of their own destiny and, put more labor in for more income. But really, it's that savings and that income they generated over a lifetime that's now working for them, and that's going to generate income for them in retirement. So today we're going to talk about a couple different elements of that. We're going to talk about making some smart decisions in certain areas, particularly on Social Security, which, I think people sometimes get a little bit emotional about Social Security. So we're going to talk through that a little bit. The next part that we're going to talk about is really the tax side of things. Just like in your working life, you'll do things over the course of time to mitigate tax and keep as much income as you legally can. And that's really the same in retirement. Effective tax planning can really have a big impact on the amount of dollars that you end up having available for your lifestyle. And then the last part, those first two parts are kind of the science of kind of the retirement planning, and that, you know, the decisions are relatively clear. It's just a matter of getting good advice and making good decisions. The investment side is a little bit more of the art side of things. You know, that tends to be a little bit more transitory and change over time. You know, your retirement's going to be relatively long. It's going to be, you know, 25, 30 years, something like that, particularly with life expectancy continuing to improve. And so there's going to be changes over the course of time on the investment side of things. So we're going to talk a little bit about, you know, ways to mitigate some of those changes, and then also just kind of talk through some things that are maybe changing right now compared to where we were a couple of years ago on the investment side of things. So we're going to start on the Social Security side. And, you know, a lot of people come into our office, the very common discussion that we have, you know, when we get new clients, you know, we kind of hear a little bit of these, you know, a little bit of alarmist kind of things like, oh, you know, will Social Security be there, you know, in a couple of years? Will it be there over the course of my retirement? Those kinds of things. You know, we're very much in the camp that, you know, Social Security for the current generation of retirees, you know, isn't going to change much from what it was in previous generations of retirees. There might be some modest, you know, changes over the years kind of thing, but it really shouldn't have much of an impact on the current generation. And so, you know, because of that kind of fear that we hear sometimes, you know, people want to ask us, you know, should I take my Social Security right away? And maybe if you just go to the next slide, Marcia, you know, should we kind of take our Social Security right away? And there was just a study that was done by a group out of Boston University, kind of looking at, you know, broadly Americans, broadly how they think about Social Security, et cetera. And, you know, one of their biggest takeaways from that study was that pretty much everybody should wait until what's called full retirement age, which is the age of 65, to collect their Social Security. And really, the vast majority, probably nearly everyone on this particular call, should really wait until the age of 70. We're going to talk in a minute on why that is. But, you know, given that stat that 90% of Americans should be waiting until full retirement age, it's kind of surprising to see that only 10% do actually wait until full retirement age. And if we look at the next slide, we'll kind of talk about why that could be, you know, have a relatively big impact on somebody. You know, over here on the left, you can see this particular person, if they retired at the time, or if they began taking Social Security at the earliest possible time, which is the age of 62, for this particular person, it would be about $1,100 or a little over $1,100 in monthly income generated by Social Security. If they wait until full retirement age, which is 67 years old, you can see that number is now $1,658. So pretty substantial increase by just waiting from 62 to 67. And that's a monthly number. That's not an annual number. So now you're talking about, you know, $6,000, $7,000, $8,000 more per year. And then finally, if we go out to the age of 70, you can see that, you know, from that initial retirement amount, you get about 124% more than you would have originally. So now you're talking about $2,000 per month versus $1,000 per month if you'd taken it at the initial retirement age. And now, you know, like I said earlier, life expectancy continues to increase, continues to improve. You know, if for this particular person, if they lived to the age of 90, now that increase in total dollars that they would have taken from Social Security would be nearly $250,000. So it's a pretty substantial amount if you think about it that way. And, you know, the other important thing to remember here is the difference between that 1,658 at 67 and a little over 2,000 at full retirement age. That's about an 8% increase per year on those benefits. So if we think about, you know, a U.S. Treasury bond today is something like a 3% yield, or, you know, the average stock market return over an extended 20 or 30 years is a 7% return, and you're having to take a lot of risk to get there. This is essentially an 8% guaranteed return that the federal government is giving you by being able to wait between 67 and 70. So, you know, it's really something that we think is important to consider at the beginning. It's important. It's something that's important to talk to an advisor about and kind of, you know, lay it out in a quantitative fashion and see what the real difference in benefits is. Because otherwise you end up making an emotional decision. Oh, I've been working all my life putting this money in. I want to get this money out now. And it really isn't kind of the best or most rational decision. So that's something that we think is very important. People should certainly get advice. And, you know, everyone's situation is going to be a little bit different. The other thing, just real quick, that we see people are surprised about a lot is there's also a spousal benefit that is part of retirement. So even if your spouse maybe worked, at the beginning, and then you had a family that didn't work or something like that over the course of time, that spouse is still going to get 50% of whatever benefit that you're entitled to. So a lot of people are kind of surprised by that. It's certainly something else that you need to consider at the beginning and put into some kind of financial plan. So that's the first part, Marche, just that importance of, making sure you talk to somebody and really understanding what the ramifications are of when you take those benefits, because over the extended period of your retirement, the dollar amounts start to get pretty big.
So this is a good question that we just got in, and I wanted to ask it because it applies specifically to what we're talking about here. Shouldn't you also take into account your investment income? So that 8% return should be estimated against the investment gains that you get earlier if you take it out earlier. Can you talk a little bit about that?
Yeah, so that is correct. So if you think about it from a compounding perspective, right? So let's say in our assumption here, we're assuming that you're utilizing these dollars essentially as your income, as part of your income to live on. You are correct, though, that if you were to take the dollars out and just invest them, there would be a compounding impact to that. But in general, you're still going to be better off as long as you have the other assets to live on. And we'll also kind of talk about this in a minute. There's some windows of opportunity from a tax perspective as well by not taking that income, because Social Security is taxed as regular income. Let's say you have an account that's an after-tax account, dollars that you've saved not in a 401k that you were able to live on, in those intervening years between retirement and that age 70. Those dollars aren't subject to tax. So there's actually a lot more opportunity to do some tax planning and stuff by not having that extra income, if you will, generated by Social Security. So you are partially right, and it's certainly something that would go into the consideration of it, but almost always you're still going to be better off with those dollars and waiting until that age 70.
All right, we're getting some more questions here, but I'm just going to keep some of these and hold them to the end.
Mhm.
And let's go ahead and move on. Folks, if you have questions, go ahead and put them in the chat. I am keeping track of them, and I'll make sure we'll address as many as we can today.
Yeah. So now, the next part of it, everyone's kind of, least favorite word, if you will, which is tax. And, it certainly becomes relevant in retirement, particularly for people where, a majority of their assets are in pre-tax retirement dollars. So, think about people that have been saving in their 401ks and that kind of thing over the course of their lifetime. Now that money comes out, either you roll it into an IRA is the kind of the most common methodology kind of once you retire. So we really need to start to think about our dollars now as pre-tax dollars and after-tax dollars. So the pre-tax dollars, don't forget, when you take those out of an IRA, those are then subject to tax at your ordinary income rate. And so that's why a lot of times you'll see people talk about the idea that, we want to roll it into an IRA. And now in my example a minute ago, let's say we're not taking Social Security for those first couple of years. Now we have a very low income, potentially that gives us opportunities to tax plan around those dollars. So, the first thing that we talk about here is that's important from a tax planning perspective is, and this is where an advisor really comes into play. And the software now is just so good on this stuff where it'll give recommendations and tell you how to do it the most efficiently. But, in my example here, we want to use a withdrawal strategy that minimizes taxes. So that means, maybe we take part of our money from pre-tax dollars, part of our money from post-tax dollars, because we want to keep our total withdrawals under certain percentages and graduated tax rates. And I don't know how familiar everyone is with how the tax system works, but for each kind of graduation, let's say from 0 to 20,000, the tax rate is X. From 20 to 50, it goes to Y, etc. So we want to try to keep our total dollars below those certain thresholds to minimize taxes. The next thing on here is, strategic investment placement. And back to kind of our example a minute ago, equities, which are stocks. If we use instruments like that and they appreciate in value and we sell them, that's subject to a capital gains tax. If you've owned that for more than a year, that capital gains tax is 20% or something, 15 to 20%, depending on your tax bracket. On the flip side of things, if we have investments that are throwing off either dividends or interest, those are generally taxed as ordinary income. So once we get into retirement, we want to try to have our stuff that's throwing off throwing off returns that are exposed to ordinary income, we want to have that in our retirement accounts. And on the other side, the certain assets that we have that are throwing off capital gains, which are a lower tax rate, we might want to have those in our after-tax account. So that's an example. Another example that is the Roth conversion, and it's a little bit too much detail to kind of talk to here, but there's certain periods of time, particularly the period of time between when you actually retire and when you're forced to start taking Social Security, that we can do things where we can convert current retirement assets into after-tax retirement assets, pay those taxes up front, but now those Roth IRAs can appreciate over time and there'll be no tax eventually when you took that money out. So that's another example. And then the last one is, charitable strategies. We see this a lot of times with people who maybe make annual donations to their church. They know they're going to make those donations over time. They know it's a certain, dollar amount per year. But one thing you can do is you can kind of front load that. You can take that money, put it into a certain charitable trust, take that full tax deduction in that year, and then you can control how you distribute that over time. So that might be really impactful to someone in those first couple retirement years when we're trying to limit your income and allow you to do things like Roth conversions and other strategies.
All right, we have a question here that I thought was applicable, and then I know we're going to move on to some more tax planning strategies. But can you talk a little bit about the tax consequences of moving from money from a standard, I'm assuming they meant IRA, to a Roth IRA? And is there a place to find a formula for this strategy?
Yeah, so it kind of goes back, and then there's kind of Roth conversion calculators online, but it's also something that's really kind of, once again, kind of best addressed with an advisor or something like that, because like I say, the software now is so robust that we can do kind of certain scenario analysis and those kinds of things. But kind of from a high level, the idea is back to my example a minute ago, the year that you retire, let's say you retire when you're 65 and you have no income in those years because you're going to wait for Social Security until you're 70. And now let's say in that example, you have a decent chunk of assets that are just in your savings, whether that be in the stock market or cash in a bank, something like that. So those years between when you retire and when you have to start taking Social Security, those are the term we use are gap years. And those gap years oftentimes give you a big opportunity to do a Roth conversion. So what that would mean is let's say I have $150,000 in an IRA, and in those years, generally my income is going to be close to zero because I'm not going to be getting any income. I'm going to be living off cash savings. That means that in those years, we can take advantage of those really low tax brackets, whether they be 0% and 12%, and then the next one's 22%. We can basically take our money from our IRA, convert it into a Roth. We pay the taxes up front on that, but that's okay because it's at those really low rates of either 0 or 12. And now the beauty of that is that money can now appreciate into the future. And let's say you take it out 15, 20 years from now, you get all that capital gain in there and you don't have to pay any tax on that. And it's also an estate planning strategy a lot of times where, your kids are eventually going to get that money. They're not going to be taxed on it when it comes out of a Roth IRA versus an IRA. So there's a lot of different levers to pull. It gets a little bit kind of esoteric at certain points. That certainly everyone's a little bit different. And so you have to kind of grind the numbers. But, it's certainly something you want to talk about. It's something that most retirees have the ability to take advantage of. And, a lot of them don't. So it's something that you certainly want to either ask somebody about or do some homework on, because it's certainly something that's going to be, after tax dollars are going to be more valuable to you.
And then one more question, kind of a follow-up. Is there a dollar limit that can be moved from an IRA to a Roth in a conversion?
Not a conversion. So the way that works is during your working life, there's certain caps on the amount of dollars that you can make in a given year. There's not a cap on the amount you can convert. The only cap at a certain point is you don't want to get up into the very highest tax brackets because you're going to pay that tax anyway eventually. It's really, the caps are those graduated rates of 0 to 12, 12 to 22 from on your federal income tax. So there's no cap, but there's certain points where it doesn't make sense to do it.
All right. Well, we keep on getting in more questions, and like I said, I'm keeping track of them, folks. So we'll keep going. And thank you so much. Keep asking good questions.
Yeah, so these are just a few things, and like I say, these are just a few things to kind of consider as we start to get into that tax planning. These are a little bit of them are kind of maybe 5 years before you're planning to retire, then kind of into retirement. But one of the things we like to encourage people to do, if they can, is to try to have multiple buckets of savings. And what I mean by that is, try not to only have your 401k, which is a pre-tax dollars. Try to have some savings that you're using elsewhere, or whether that be some real estate assets or something like that, other vehicles that we can tap when you get into retirement, because that gives us so much more optionality. If you have the ability to access ready cash in those first couple years of retirement to live on before we have to start doing withdrawals and those kinds of things, that gives us so many more opportunities, and you're going to save a lot more dollars in the long term by doing that. The second thing is
I'm sorry, you broke up right then.
Sorry.
Could you repeat that last little part?
Well, I was just saying that, having that opportunity to have multiple buckets available to you, it gives us a lot more. It gives your advisor, your tax planner, a lot more optionality in what kind of strategies they can execute. Because, if you only have one kind, it kind of eliminates half the board of things we could potentially do. And that's why you want to try to do that in advance. The second part is, we have this conversation with clients all the time. And I think most people understand it, but I think they're kind of surprised. Someone will come in and they'll have $1 million in their IRA. And, you really have to think about that, though, in after tax dollars. So you have to assume you're going to be taxed at 30%, 35%, whatever it might be over time. And so it's just kind of a way to think about your retirement, those kind of things, to always be thinking about everything in after tax, because unfortunately the government's, always going to take their cut. That's probably not stopping anytime soon. If anything, there might be further pressure kind of on that in the future. One last thing, and this is a little bit more early, people for a little bit, a few years before retirement, but an HSA, which is a health savings account, it's something that's not available to everybody. It's only available to people with certain health insurance plans, but it's an incredible opportunity. It essentially gives you the ability to put aside excess dollars beyond your 401k, beyond your IRA contribution, and that money can grow tax-free in perpetuity. And then you can take it out tax-free as long as you're taking it out for some kind of medical or health related issue, but that could even be long-term care or something like that. So we kind of encourage people to think about using that HSA if they can. If you're still working, reach out to your benefits manager, see if that's something that's available to you, because things like long-term care, the insurance is so expensive now that for the current generation or previous generations, it's almost cost prohibitive. And so something like this gives you the ability to save, kind of like you might have with an insurance plan in the past. So that's something that we recommend you reach out and kind of find out if it's available to you. So those are kind of, the blocking and tackling, and there's obviously a lot more detail that's involved in that. But, my point on those two things is there's so many different variations and so many different kind of options. It's really important, I think, to get advice and, get advice from somebody that, has done it 100 times before. That's kind of what we tell clients. Sometimes our value add is, we have 150 people or 1,000 people that look like you. We've done all this before. Think about anything else you do. It's kind of like I have my 5-year-old, my 11-year-old, they're surprised I know how to do something. I'm like, well, I've been doing this for 40 years kind of thing. So it's kind of the same thing here. Get that advice because it's going to help you to make good decisions. So now we're going to kind of move forward to the art side of it a little bit, which is kind of the investment management. As I said, this is going to evolve over the course of your retirement. But the most important thing from our perspective is that we want to generate consistent returns and returns that have minimal volatility, which means minimal year-to-year variation. And why is that? Think about it in your working career. If every year at the start of the year, your salary was going to vary by 25% or something like that, it would be very hard to plan for whatever you're trying to plan for. And so really, if we think about your assets as your labor, we want those assets to generate consistent returns so that you can plan your retirement year to year and not have that variability. So the first part of this is just kind of, your life cycle as a worker. We call it the life cycle of investing. If you look all the way over on the left, you can kind of think about that being your 20s. You're accumulating all those assets over the course of your lifetime. When you get to say within 5 years of retirement and 5 years after retirement. That's kind of what we call that consolidation phase. That's what we're going to talk about in a minute. That's really the most important time to get the asset allocation right. Because if you think about it, if you're 25 and you're 100% in stocks and 2008 came along and you went down 40 or 50%, it would certainly be painful. You certainly wouldn't enjoy it, but you have a whole bunch of time to make up for that. And truthfully, it's probably an opportunity because you're going to be able to get more dollars into the market at lower prices. However, when you get into your 50s and 60s, and now we know we're getting close to having to withdraw those assets, we have to be much more cognizant of what that asset allocation looks like. And we have to, really be thoughtful about avoiding drawdowns and volatility. And then, out to the right is just kind of the distribution phase. That's slowly working off those assets as you get into your 80s, 90s, and then, leave an eventual legacy of estate. So that's kind of how we think about things. We're really going to kind of focus on that consolidation phase and then that distribution phase today, and kind of how we think about those things. So, the traditional way for, probably 30, 40 years now that advisors have really kind of mitigated that risk of volatility in those years, immediately preceding and immediately after retirement, is really kind of setting up a portfolio that's certain percentage stocks, equities, certain percentage bonds, and fixed income. And, the textbook and probably most common way to allocate those has been something like 60% stocks, 40% bonds, particularly kind of around the time of retirement. And so, it hasn't been a terrible strategy, but we're going to kind of look at, some times where it hasn't worked out that well. And particularly last year was one of those times to kind of talk through that a little bit and talk about ways that we can now mitigate that risk, because there's other things that are available to investors like us that maybe weren't available a decade ago. So let's just kind of move through a little. So this is the 40 part of that portfolio, which is the fixed income portion of the portfolio. And, fixed income as an asset class has really changed over the last 30 or 40 years. You can kind of see back to the 60s here. This is about how much income you would have generated from $1 million portfolio of 10-year treasuries. So extremely conservative, extremely stable investment here. And, look at that variation over time, but you can see the trend, particularly from the 80s, is essentially down. And I have a 102-year-old grandmother, believe it or not, who had some 1980 U.S. treasuries that at one time were yielding 18%. So, think about that on $1 million portfolio, you'd have $180,000 in income. So, for a long time, you almost didn't need anything other than kind of fixed income to fund your retirement. As we look over here, though, in the last, say, since the 80s, that number has come down considerably. And as we got to 2020, post-COVID and those kinds of things, when rates kept coming down, the amount of income that could be generated from a fixed income portfolio was extremely low. Now, it's come up a little bit again today. We know the Feds have been raising rates in the last, 12 to 18 months. Today, that number looks closer to that 2010 number, maybe $32,000, $33,000, something like that, but still considerably less even than 2000, even than just 20 years ago. You're talking about half the amount of income. So, the point here is we can't just rely on fixed income, and we also, can't rely on, those higher rates in the future kind of, providing us with the income that we need for retirement. So bonds, certainly much different than they were 20 or 30 years ago. So that part, that 40% part of the portfolio is dramatically different. And then, particularly last year in particular now, we saw that 60-40 portfolio was particularly, performed particularly poorly. And the reason for that was, in other generations before, or in other decades, or when bad things happened, the yield on those fixed income bonds, let's say it was 4 or 5%. So let's say the stock market was down 10, this was up 4 or 5. Now your return was maybe, -6. Not great, but certainly not that painful. But now, because rates started so low, and because fixed income prices go down as interest rates go up, we had a very bad year last year for this portfolio. And, you can see there, the third one down, minus almost 17% for the full year last year. And at one point it was down, 19 or 20%. So, that 60 portfolio, we kind of call it recency bias, which is just because something's done well for 15 or 20 years doesn't mean it's going to do well in perpetuity, doesn't mean you shouldn't be thoughtful about it. So we're in a period now where we just were proved last year that 60-40 portfolio potentially is riskier than we thought it was. And then one thing, we love this next slide because we think it's pretty interesting. Last year was real bad, but it turns out that, this is a 60-40 portfolio all the way back to 1900. And what's kind of interesting about this is, we've gotten so used to that portfolio doing so well between, say, the mid 80s and kind of going into 2020, that when we go back and look, it's interesting to see that there's actually been extended periods, or what we call a lost decade, where the 60-40 portfolio, while it wasn't down a whole lot, it also wasn't up a whole lot. And that can be extremely impactful to a retirement portfolio. And, one of those numbers at the bottom, which might not be that easy to see, but one of the things that has been a preface to a lost decade in 60-40 was extremely low interest rates and extremely high stock market valuations. What did we have going into last year? We had interest rates, under 1%, and we had stock market valuations extremely high. Not surprising that we see a down year or significant down year for 60-40. And the reason why that's impactful, when we remember that first slide we looked at that showed you in that consolidation period, if you go to the next slide, these are two portfolios here. These are two portfolios that have a 4% withdrawal rate from their portfolio. So let's say $1 million portfolio, we're going to take out $40,000 a year to live on. The blue line is just 5% stable growth over time. The red line is the first 10 years of retirement is that lost decade, that not even a negative, just a zero growth. And then it grows at 5%. But because you had to withdraw your 4% at those beginning years, it has a huge long-term impact on the portfolio and its ability to compound. And, here we are out to age 99 in this example. The person on the blue line, they still have, over $1 million. The person on the red line is, running up against their assets. So that's why it's so important in that first period, right before you retire, right after you retire, to really be thoughtful about asset allocation and how you do things. So, that kind of begs the question, okay, if we're not just going to do stocks and bonds, we know we can't hold cash, what else can we do? What are some other solutions to kind of, mitigate that risk of that lost decade? And so one of the, there were probably a lot of bad things that kind of came out of 2008, the financial crisis. One of the really good things that came out of that, though, was there were a lot of other asset classes that people had been investing in, that people had been developing ways to invest in, but they were pretty much all tied up inside the bank. So inside a Bear Stearns or a Merrill Lynch or those kinds of things. After the financial crisis, because of some regulatory changes, a lot of these different kind of investments or asset classes were able to come out of the banks and are now, at first they were just available in a hedge fund format, which is extremely expensive for individual investors. Today, these different asset classes are available really to any of us and really at very low fees, sub 1% kind of fees for most of these, maybe some slightly higher, but the diversification benefits justify those fees. So let's just talk about a couple of them just to kind of give you ideas. And the most important thing to think about when we talk about these asset classes is that their returns are going to be uncorrelated to either interest rates or the stock market. So it doesn't matter if the stock market's up 10,000 points, down 10,000 points. Doesn't matter if interest rates are at 0 or 10%. These particular assets are going to generate returns independent of those circumstances. So I'm just going to talk about one or two just to give you an idea. One that I always kind of like, I think is really interesting and really easy to understand, is music royalties. So there's a fund that essentially just purchases libraries of music. Every time that music plays, either on one of the digital music channels, on a radio, etc., they get a royalty from that. And it's pretty interesting when you talk to them. This isn't the latest song that won the Grammy Award. These are songs that are either bands that have been around for ages, or, believe it or not, one of the funds owns the Happy Birthday song. So every time the Happy Birthday song is on, certain thing. And I always kind of tell an anecdote. My dad was the president of kind of a community association where they live. And they had a dance, and there's the 70-year-olds in there, and they came into the dance. And next thing you know, there was an attorney calling them up saying they had more than 100 people at this thing, and they owed a music royalty thing. So I told my dad, for him, that sounded terrible. I thought it was great for, our fund that owns these various music royalties and that kind of thing. But, it doesn't matter what the stock market does or the bond market does. These songs are either playing or not playing. And if you look at the data, it's very consistent year to year. So that's one example. Another example is catastrophe. And this is kind of interesting because a lot of people get concerned about this with things like climate change, etc. But catastrophe is essentially insurance. So it's insurance on any number of things all over the globe. So it might be typhoons in Japan, hurricanes in Florida, crop insurance in Iowa. So you've got this broad range of diversification. And, insurance is pretty interesting because, for the most part, right, we all pay for insurance. It's almost the only thing you pay for that you hope you never need. But it's a very good business. And one of the insurance guys told me once, have you ever noticed the biggest building in every city is usually, you got the MetLife building in New York, you got the Transamerica building in San Francisco. I was actually just in Cincinnati and there's American Insurance. And that was the biggest building there. So it's a really good business over time. And essentially, because you have all these different risks all over the world, there might be a hurricane some years in Florida. There might be a typhoon some years in Japan, but you're spreading your risk. And in general, you're taking in more in premiums than you're paying out over time. And interestingly, this year, there was that big Florida hurricane last year. People would have thought, oh my goodness, that's a terrible time to own it. Well, believe it or not, it was down a little last year because of that. But because just like if you have a car accident or 4 car accidents, whatever it is, what happens to your insurance premiums? They go through the roof. Same thing here in Florida. So far, the insurance linked securities this year are up 6 or 7% already because premiums in Florida have gone through the roof after the hurricane. So once again, just to reiterate, the most important part of that is totally uncorrelated to economic cycle, interest rates, stocks, etc. So we have a portfolio, and it's available to anyone you can do work, but we have a portfolio now of about 10 of these that are all different risks that are uncorrelated to the stock market and the bond market. If you go to the next slide, this is just kind of lays it out, I think.
All right. And then we did have a question here.
Oh, yeah,
if
go
you
ahead.
can explain what fixed income, what that exactly means, because there was some confusion on that.
Yeah, sorry. So fixed income, it's kind of like interchangeable with, equities and stocks. Fixed income is really just a bond. So a bond compared to a stock, just so when you own a stock, let's say I own Disney, if I own a stock in Disney, I essentially own a tiny share of, every movie Disney's ever made, Disneyland, Disney cruises, et cetera, et cetera. So I own a tiny equity stake in that, and my way to kind of to generate returns over time is Disney's going to sell a bunch of tickets to Disneyland. That's going to generate cash. They're going to take that cash and make a new Star Wars movie or whatever it is. So they're going to take cash flow. They're going to generate new assets with that cash flow. Those assets are going to generate cash. And over time, the value of what I own is going to appreciate. My risk in that is that, people decide they don't like Mickey Mouse anymore. No one goes to Disneyland, and kind of the reverse scenario. Fixed income, a bond, is much more like, your home mortgage or something like that. So if I have a bond and I'm a company, rather than selling you a piece of everything I own, I might come to you and say, I want to build a new factory to make a new product. I think this product's going to be a gangbuster, so I don't want to give up any ownership in it, but I'm going to borrow some money from you to build my factory, and I'm going to pay you interest and eventually pay you back that total amount, just like your home mortgage. The bondholder, though, let's say your factory doesn't work out and you're not able to sell the product. Well, now the bondholder, just like the bank could potentially foreclose on your house, they have an asset they can come and get, which would be that factory. So fixed income is much more conservative. It pays an interest rate usually. It's like a cash flow versus a stock that, it might pay a dividend or something like that, but really a stock is a higher risk. You're betting on the long-term growth of an enterprise, whereas a bond, you're just betting on that period of time that the company, is borrowing money for you from, and for borrowing that money, they're going to pay you interest payments.
Thank you. Thank you so much for backtracking on that. I'm not sure everyone understands that. One of the things about these webinars is we like to make sure people know they can ask questions like in vocabulary. I feel like vocabulary is one of the biggest thing in this industry that can trip you up if you're new to it.
Yeah, and that's always kind of one of the best things we feel like about. It's funny because sometimes we'll have, almost all of our clients are probably, couples. Like I say, our niche is kind of that 50s and 70s. And it's kind of nice to see sometimes, one of the couple might have been doing most of the financial stuff, and they'll come in, and it's really great to see the other one kind of come out and kind of ask questions and stuff. So we always kind of appreciate that. So it's kind of nice. This just kind of shows, there's old asset allocation. Here's kind of risk allocation. The next slide is really the one that kind of brings it together a little bit. And so I know this is kind of an ugly drawing. Frank Sternick, that owns our firm, always hates this, but we haven't really found a better way to do this. But on the left here, that's that 60-40 portfolio. And what those lines indicate is statistically, what's the range of outcomes? So back to my analogy earlier that, if in your working years, your income varied widely, it would be very hard to plan. That shows you on the left that, when we just use stocks and bonds, there's actually quite a big variation of outcomes. So that middle line is kind of anyone that's done any statistics, there's like that, there's the bell curve that they say, in the middle of that curve is kind of, the 50% probability, the most likely set of outcomes. That's what that solid line is. But then once you get into the, the 90th percentile or the 10th percentile, those are kind of best and worst case scenarios. And so that just shows you that the range of outcomes is a lot wider because the underlying assets are really pretty related to each other, as we saw last year when stocks and bonds both went down considerably at the same time. Whereas the chart on the right, that's now our fully diversified portfolio where we have stocks, we have bonds, we also have, music royalties, litigation finance, catastrophes, all these other things. And, now our range of outcomes is a lot narrower. And for us as investors and as retirement planners, that's significantly more important, even than, squeezing out the last dollar of return. It's much more important to get that consistency of returns, because that's what's going to allow you to, enjoy retirement, not be check your computer every day, all those kinds of things. So that's why we really encourage, talking to an advisor or doing research on how to diversify your portfolio, further beyond even just that kind of traditional equities and fixed income.
All right. I know we're going to wrap things up, but then we have a bunch of questions. So
Okay.
We'll go ahead and get into these after the question.
Yeah, so I'll just go through this pretty quickly. We all kind of understand, the first thing I say is, make sure at that initial point of retirement, or even, as you're approaching retirement, get advice or do a lot of research on your own, because, those initial decisions can have a big impact over time. The second thing is, focusing on tax and thinking about all of your money, in an after-tax way. The whole thing is kind of keeping as much of your savings as you can, making sure that you're not, taking advantage of everything that's available to do that. And then the last thing is, you can't just own stocks and bonds anymore. And, it would be really hard for us to tell you that if there weren't a whole bunch of other asset classes now available at prices or at, fees that make sense. And there is that stuff available now. And so by kind of further diversifying, we can, really narrow that range of outcomes.
All right. Well, let's go ahead and get into some of these questions. Again, our time is limited, so I will tell the attendees, if we don't get to your question, don't worry. I am keeping a record of those, and we'll make sure to reach out to you if we're not able to get to your question today. So our first question is, how do you get into these kind of diversified investments? Can you talk a little bit about the process?
Yeah, so it's kind of interesting. So it kind of goes back to what I said a second ago, that, there are a lot more available than they were in the past. Some of these things are available in just a standard, mutual fund format that you could just go ahead and buy, just like you would any other asset. That's some of the things like long, short funds and that kind of thing. There has been, one big innovation in the last few years that's allowed a lot of these asset classes to be available on a broader basis. It's something called an interval fund. What that means is, rather than something that you can sell every day, you could only sell it periodically, so quarterly generally. And if you just think about why that would be relevant, let's say we're in an insurance asset or something like that, and we know that in order for it to work out, we need to own all these different insurance assets or different people's premiums getting paid in, and we need to own them over a course of time. Well, let's say there's a hurricane in Florida and everybody panics and they're trying to sell the insurance asset, that would be detrimental to everyone else in the fund. So they've developed something called an interval fund where, it's only liquid on a certain period of time, but you're still getting the yield. So you're still getting that money coming out of it, which is for retirees, that's really what we care about, right? We really want to own that insurance asset over a full period of time. So this new structure called an interval fund has allowed for certain assets that, might not have been able to be utilized by individual investors to be utilized by individual investors. But, there's a whole number of them out there. it's just kind of a matter of doing research or talking to an advisor.
All right. Thank you so much for that. And I do know that that has probably more to do with your experience in hedge funds. Can you talk a little bit about um, what sort of assets are you generally in a hedge fund as opposed to maybe a typical retirement account?
Yeah, so it's funny because hedge fund has kind of has really changed. It's kind of like one of those words that probably has 100 different meanings, kind of depending on who you're talking to. The original idea of a hedge fund was that you would have something that you own that wouldn't be exposed to the underlying market as a whole. So, if the market went up 1,000 points or down 1,000 points, that your particular assets wouldn't be exposed to that market movement. And the way that you did that was, and it maybe is a little bit more technical than for this conversation, but there's something which would be long a security, which would mean you think that that value of that company is going to go up. And there's something called short a security, which means you think the value of that security might go down. So the original idea of a hedge fund was they would go out and do work and say, oh, you know what? I think Coca-Cola is really expanding in Latin America, so I want to be long Coca-Cola, meaning I think it's going to go up. And by the way, in order for Coca-Cola to do that, they're taking market share from Pepsi. And so I'm going to be short Pepsi. And the idea is you're making a investment based on the idea or the hypothesis that Coca-Cola is going to do better than Pepsi. But by using both of those securities in equal amounts, one long, one short, you're hopefully taking out, maybe Coke going way up because the market goes, or Pepsi going way up because the market goes up 1,000 points, or Coke going way down because the market goes down 1,000 points, because being long and short is going to balance that out over time. So that was the original idea of a hedge fund. And, what you were doing there was you were getting more consistent returns. Today, hedge fund can be used to mean a whole bunch of different kind of esoteric investment methodologies. But at its very core, the idea of being hedged is to be, kind of long and short, so that you're taking out the actual market movement and you're getting a more consistent return. We would argue that entire what we call alternatives portfolio, which is that whole list that I'm talking about, that's really a hedged portfolio, because all those things are reacting differently to each other as well as to the market as a whole.
Thank you so much. I know that is something maybe we need to explore in a future webinar. You talked a little bit about alternatives being, what you would call the kind of a diversified assets that you had mentioned. How did the alternatives portfolio perform last year when nearly all assets were down?
Yeah, and that's a good question. It's kind of interesting because, that alternatives portfolio that we've had, or that we have, when we first initiated, a lot of those assets that maybe only have a history of 7 or 8 years. And so when we first initiated a lot of that stuff, some of it was a little bit philosophical in that we went back and looked at how it all performed, and we were pretty sure how it performed in a down market. There's kind of a Mike Tyson quote, everybody has a plan until they get punched in the face. That's a little bit of what the portfolio was. And even, I'm going to talk about this here, but COVID was really the initial punch in the face where we were pretty sure how the thing would perform, but we hadn't really seen it go through a period of, extreme downturn, and the portfolio did, really well. Certain assets did great. Certain parts of it didn't do quite as well, but on balance, which is exactly what we planned for, the portfolio did really well. Same thing last year. Last year, interestingly, different assets that hadn't done quite as well in COVID did really well. Some of the stuff that did really well in COVID didn't do quite as well. And so now we've kind of been through 2 periods of stress with that portfolio, and seen how it's performed, and it's significantly kind of outperformed the fixed income benchmarks. And that's why kind of our balanced portfolios that we call them, the stuff that's competing with 60-40, did really, really well last year compared to benchmarks.
All right, can you talk about RMDs and when you have to start taking that out? To explain a little bit about RMDs. We had a question about that.
Yeah, so that's really important, kind of back to that, what we were talking about on the tax planning side of things. So, we talked about those gap years kind of between when you say retire and when you have to start taking Social Security. The other part of that is an RMD, which it stands for required minimum distribution. And what that means is is at a certain age, and they've actually just raised it. It was 72 and a half. Now it's 73 to 75, depending on when you were born. But what that means is, you know, the government's not going to let you have those assets appreciate forever tax-free. They want you to eventually take that money out. And when you take it out, you have to pay taxes on that. And so that's where all that planning comes in, you know, knowing that we have this finite window of time before you're required to take those minimum distributions. And, you know, for certain people with $1 million plus or $2 million IRA, it can be a pretty significant dollar amount. So, you know, how it works is from that period, whether it be 73 to 75, you have a life expectancy and you have to take out a certain percentage each year based on that life expectancy. But you really want to be cognizant of that going in and know, you know, when your RMDs are going to start, because that's going to affect everything else from the tax planning to Social Security planning, et cetera.
All right, I'm trying to get through all these questions. Again, I did have a couple people put in their phone numbers in case that I wasn't able to get to their questions. So you're welcome to do that now. If you haven't got your question answered, I'll try to get to as many of them as I can. Can you address real estate investments? And notice it wasn't on that list there. How does real estate figure in a portfolio like this?
Yeah, it's interesting because, you know, and you're right, real estate's another asset class. You know, traditionally there's kind of two ways to access real estate. You know, the most common obviously is our primary residence, which, you know, majority of people probably approaching retirement own. I'm just going to kind of address one topic on that because it's become really relevant lately. Is, you know, a lot of people come in and they'll say, oh, I'm about to retire. You know, all my life I've dreamed about paying off my house, you know, when I retire. Well, a very large majority of people today have refinanced their homes in the last, you know, 3 to 5 years, you know, with rates. I mean, it's crazy. People come in with rate 30-year mortgage with 2.75% rates. You know, I told you about my 102-year-old grandmother. She tells me about a 15% mortgage they had back in the 80s. So, you know, if you just think about that. And so it's interesting because it's kind of back to the reason of using an advisor, using financial planning, those kinds of things, because we'll say to people, well, you know, you have a 2.75% rate on your mortgage and our investment return is 5, 6, 7%. You know, it doesn't make any sense to take these dollars today and, you know, pay off your mortgage, which you're only paying, you know, 2.75% on, if you're going to earn 5, 6, 7% on those same dollars. So it's funny how that's kind of changed. And something else that people go, oh, you know, maybe that whole thing I always talked about my whole life of, you know, paying off my mortgage right away at retirement doesn't make sense. So it's another reason why, you know, sometimes what in your mind sounds like the right decision, if you kind of lay it out and think about it in a quantitative manner, you know, maybe isn't. You know, back to real estate, just as an investment in retirement, you know, we like real estate. You know, we've done some private real estate deals and those kinds of things. You know, if it's your own home or you have properties for rental, you know, those are always nice in retirement. There's tax advantages to those. They throw off cash flow. Also today now, you know, there's public ways to own them. It's called REITs, which are real estate investment trusts, which just gives you the ability to say own, you know, a whole bunch of office buildings that have, you know, Google and Apple as tenants and those kinds of things. So we know they're going to have pretty consistent cash flows. You know, the only thing that's happened a little bit in real estate today is, you know, when rates were at 1 or 2%, a 4% yield from real estate looked really good. If today the interest rate on a treasury bond are 5 or 6%, you know, some of that stuff doesn't look as good. So that whole market has changed a lot because of interest rates, and real estate in general is very interest rate sensitive. So we would kind of consider it more of a traditional asset class than an alternative asset class.
All right. Well, talking about interest rates, you talked about how the place of bonds in a retirement portfolio has changed since previous generations retired, and now the interest rates have risen. What's the place for bonds in your portfolio?
Yeah, so it's a good question too. So remember we kind of talked in that thing, we said 60-40 was the traditional portfolio. You know, last year for us going into the year, you know, we were probably 60-40, but it was 60% stocks, 40% those alternatives. That's because interest rates were so low on any of those fixed income instruments. Today, those interest rates are more like, you know, 4%, even a 1-year treasury today, believe it or not, it's almost 4.6, 4.7%. So we actually now can own some bonds again. And this goes back to, you know, why I said that asset allocation, you're going to be retired for 30 years. The world's going to change. You know, look at just that list of rates we put up there from 1980 to 2020. That's, 40 years. Some people might be retired for 40 years, and how dramatically interest rates change over that time. So there is actually now a place for bonds again. It just means that Monte Carlo, that range of outcomes can be even narrower now, because now we're adding another asset class with consistent cash flows. So there is a place for bonds. Last year was kind of a four-letter word. Now it's actually, kind of something to consider again.
All right. Can you talk a little bit about Social Security? Again, we have several Social Security questions in here. So can you talk about the spousal benefit and give more detail about that? Is that in addition to your own Social Security income?
Correct. So let's say for let's use an example. And let me just start off with this. Here's something that I really recommend. They used to send you in the mail all the time, and I'm sure if you get a periodic, get something from Social Security, say, this is your benefit, etc., or your probable benefit if you were retired. I encourage everyone now to go onto the Social Security Administration website, even if you're 15 years from retirement, and claim your Social Security number, attach it to an address, because there's been some fraud and other things associated with that. People can grab your address and try to, obviously it's not money you wouldn't get eventually, but just to mitigate all that, I highly recommend that you go on their website, claim your Social Security number. And it's also educational, because now you can see, just like that thing you used to get in the mail, you can see what your benefits would be at those various retirement ages, whether it be 62, 65, full retirement age. To that other question though, that's correct. Let's say I was the primary breadwinner my entire life. My Social Security benefit is going to be $2,000 a month at full retirement age. The spousal benefit is 50% of that. So in addition, even if your wife, like I said, hadn't worked for years, or maybe didn't work at all, or maybe only worked kind of periodically over time, you can get that spousal benefit that's 50%. It's either 50% or whatever they were entitled to if it's greater. So let's say your spouse actually worked for 25 years and then hasn't worked the last 10 years, and their benefit was going to be $1,200 and yours was going to be $2,000. In that case, you'd take the $2,000 and the $1,200. But let's say their benefit was going to be $600. They get half of yours, the higher amount. So that's how it works. But I would definitely encourage you. It's pretty intuitive, which is probably rare for a government website kind of thing, but it actually works pretty well on there. And I kind of highly recommend that you go on and do that.
Yeah. And typically advisors, when you work with a financial advisor, they typically have people, I know, in their network that can help you with Social Security questions as well.
I mean, that's probably, we do that. That's, like I say, that's why I kind of lay it out in there. You come in, we can lay out all the scenarios. Probably any good advice, any advisor that's worth it, when you go in there, they're going to be able to lay out all the scenarios for you and kind of talk you through it. And then, sometimes people will say, hey, here's the mathematical decision. And they'll say, I don't care. I still want to do this. And that's okay. But we just want to make sure we lay out all the stuff and kind of give you all the information to make a good decision instead of a purely emotional decision.
Here's another really good question about Social Security. Is there a possibility of taking, say you're divorced and so you have an ex-spouse and that you can get a spousal Social Security income from that? So is there a possibility of turning that on like at age 67 and then taking your own at 70? Is that possible?
No. So it's either, so you have one of those two options. Your two options are either taking your own Social Security or the spousal benefit, but you can't do both. So that's what it comes down to. You got to kind of lay it out at the time, see what the options are. But yeah, and you also can't change this. Like, it's kind of, that's why I say it's very important kind of at the beginning to lay it all out and make the right decision, because it's very difficult, if not impossible, to change it after the fact.
Thank you so much. All right, we're going to switch, and we don't have very much time, but I think this is an important one to maybe end on. This is a great question. My highest concern is where the safest place to hold assets would be that are protected from hospital and nursing home charges late in life. Talking a lot about, that long-term care component.
Yeah. So, I mean, if it's kind of in a situation where, say, your spouse or something has significant, healthcare expenses, and you're concerned about protecting assets from that, the nice thing about retirement accounts is retirement accounts are actually protected even in a bankruptcy. So, I'm not sure how specific the situation, but let's say for whatever reason, you had a $200,000 IRA and you had $100,000 in medical bills that you couldn't afford, conceivably you could go bankrupt on those medical bills and they couldn't come after your retirement assets to cover those. So that is the nice thing about retirement assets, is that they are protected, in a bankruptcy process. If you had, significant bills, or, you see that all the time. Maybe someone will unfortunately have a car accident or have some kind of business litigation. All those retirement assets or anything that's under a retirement umbrella is protected in one of those situations.
All right. Well, I would also say that speaking with an attorney who specializes in elder law would be probably a good place to go. And usually your financial advisor will have a network to talk with those kind of professionals. Well, folks, I know we still have more questions. Alec and I will talk afterwards so that we can get some more questions answered behind the scenes, but we appreciate all the interaction today. We want to thank Alec for being here and for the organizations that have made this webinar possible today. I've had this question several times, and I do want to answer that. Are we going to get a recording of this webinar? Yes, we will be sending a link to the replay of this event. Expect that in the next day or so. And you're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye,
Thank you, everyone.
everyone.
Take care.